In the U.S. fiscal year that ended September 30th, 2008, which was Bush's last full year as president, the U.S. had a record budget deficit of $459 billion. Shortly before the November 2008 presidential election, Obama promised that if he was elected president, he would cut the deficit in half by the end of his first term. Instead, the deficit tripled to a record $1.4 trillion during his very first year in office. In the last full fiscal year of 2013, the U.S. had a deficit of $680 billion, and Obama is taking credit for achieving his promise, claiming he inherited the $1.4 trillion deficit in 2009 from Bush and has now cut it in half. Although Bush was partially responsible for the 2009 deficit, this clearly wasn't what Obama meant at the time he made his promise. In January of 2009, 2 weeks prior to Obama taking office, the CBO issued its 10-year budget projections. The CBO projected a fiscal 2009 budget deficit of $1.186 trillion, which would decline to $257 billion in 2013. Obama clearly wasn't promising to cut the 2009 budget in half by 2013, when it was already projected to decline by 78%. Obama was obviously promising to cut the 2008 deficit of $459 billion in half by 2012, but instead, the U.S. had a 2012 deficit of $1.1 trillion. In fact, the CBO in 2009 was projecting total deficits from 2009 through 2013 of $2.9 trillion. But during the first 5 years of the Obama administration, the U.S. has already reported total official budget deficits of $5.8 trillion, which means Obama has doubled the deficits he inherited from Bush and is lying when he claims to have cut them in half. Shockingly, Obama's deficits have so far totaled more than the combined deficits of every other president in U.S. history. This is based on the U.S. government's unique non-GAAP style of accounting. The real U.S. GAAP-based deficit, including increases in unfunded liabilities for Social Security, Medicare, and Medicaid, has increased from $4.3 trillion in 2009 to a record $6.6 trillion in 2012, and in 2013 was the second highest in history at $6.2 trillion. The U.S. now has total federal debt obligations of $92 trillion, a 42% increase since Obama became president. NIA's method of calculating the total money supply of fiat U.S. dollars, which is comprised of currency component of M1, total checkable deposits, and total savings deposits at all depository institutions, has increased by a shocking 75% from $5.7 trillion up to $10 trillion during the Obama administration, for a compound annual growth rate of 11.4%, which is triple its compound annual growth rate of 3.8% during the Clinton administration. In comparison, total above-ground stocks of real money, physical gold, have only been increasing by 1.6% per year under Obama versus 2.1% per year under Clinton. Fiat U.S. dollars are now being printed 7 times faster than real money is being mined, which means America is currently experiencing its worst monetary inflation since the Carter administration, when fiat dollars were printed 8 times faster than gold was being mined. It was during the Carter administration when gold prices made their largest 4-year increase in history, rising from $130 per ounce up to $850 per ounce, an increase of 554%. When gold reached $850 per ounce in 1980, the total fiat U.S. dollar money supply was only $573 billion. It has since increased by over 1,600%. Even after discounting for the gold mined during this period, gold's high in 1980 of $850 per ounce is equal to an inflation-adjusted gold price today of approximately $8,000 per ounce. In NIA's opinion, the world's most important financial indicator is the Dow-to-Gold ratio, which is calculated simply by taking the latest price of the Dow Jones Index and dividing it by the current price of gold. The Dow-to-Gold ratio trends upward during secular bull markets in paper assets when everybody is fixated on growth. It trends downward when the growth phase ends, and everybody's concern is to conserve their wealth. Historically, every secular bull market for paper assets like stocks has ended with the Dow-to-Gold ratio reaching a top between 18 and 45, whereas each historical secular bull market for real assets like gold has ended with the Dow-to-Gold ratio bottoming between 1 and 2. So far during this current cycle, the Dow-to-Gold ratio has declined from a peak in August 1999 of 45 down to a low in August of 2011 of 5.67. which equals an 87.4% decline for the Dow Jones stocks in terms of real money. After reaching an August 2011 low of 5.67, the Dow to gold ratio rebounded for 27 months, finishing year 2013 at 13.76, which represents a 143% real bounce for Dow Jones stocks. At the end of 2013, everybody in the financial news media and on Wall Street became overwhelmingly bearish on gold, simply because of its short-term downward momentum and without any fundamental justification. Almost all of the sheep who jumped into gold in late 2011 when it rallied to $1,900 per ounce solely due to gold's upward momentum, without understanding gold's fundamentals, became bored with gold in 2013 and sold all of their gold, seeking higher returns in bitcoins, which they proclaimed to be Gold 2.0. Just like how Jim Cramer becoming bullish on gold in 2011 at $1,900 per ounce was a sign that gold was at a medium-term top, NIA knew that gold was near a bottom in late November 2013, when the #1 headline on every major financial portal was, "Goldman predicts steep losses for gold in 2014, after gold was already down 26% in 2013. In fact, a week after Goldman Sachs predicted a further 15% decline for gold in 2014, with gold trading at $1,230 per ounce and bitcoins trading at $1,100, Bank of America predicted that gold would decline in 2014 to $1,000 per ounce, while simultaneously issuing a Bitcoin research report valuing bitcoins at $1,300. NIA knew that Bank of America valuing bitcoins higher than gold was complete insanity, and it was right. Since then, gold has rallied 11% to $1,360 per ounce, while bitcoins have declined in value by 43% to $632. NIA in December 2013 made it very clear to its members that gold's secular bull market was far from over and wouldn't be over until the Dow-gold ratio fell to between 1 and 2. NIA explained to its members that after 12 consecutive years of gains, more than any other asset type in the world, gold was overdue for a down year in 2013. NIA pointed out to its members how during gold's last bull market of 1971-1980, gold initially soared from $35 per ounce in 1971 to a high in 1974 of $195 per ounce for a gain of 457%, but afterwards saw a steep correction to a low in 1976 of $103 for a decline of 47%. When gold bottomed at $103 per ounce in 1976, negativity about gold in the media and on Wall Street had reached a peak, with everybody proclaiming the gold bull market to be over. However, with all of the weak hands gone, nobody was left to sell at $103 per ounce, and gold afterwards made its largest 4-year run in history, rising 721% to a peak in 1980 of $850 per ounce for a total 9-year gain of 2,329%. NIA called gold's bottom perfectly in December, predicting a massive gold rally at the very beginning of 2014. NIA calculated that gold's 1976 low of $103 per ounce, adjusted for growth in the real U.S. money supply and above-ground physical gold stocks, was equal to $1,096 per ounce in today's dollars. NIA also calculated that gold's 1985 low of $286 per ounce was equal to $1,276 per ounce in today's dollars. The average of these two adjusted gold lows is $1,187 per ounce in today's dollars, which NIA predicted would be gold's bottom, and it was exactly where gold bottomed on December 19th. NIA believes from gold's December low of $1,187 per ounce, gold is likely to make a 4-year run very similar to the late 1970s. A 721% gain from $1,187 per ounce will send gold to over $9,700, where we will most likely once again have a Dow to gold ratio of between 1 and 2. Besides NIA perfectly calling gold's bottom in December, NIA almost perfectly called a bottom for gold mining stocks and predicted that shares of publicly traded gold mining companies would far outperform gold itself in 2014. On December 28th, NIA highlighted to its members how the Huey to gold ratio was down to only 0.163 and had reached a low on December 6th of 0.157, which NIA predicted would hold as its bottom. The Huey is a dollar-weighted index of publicly traded companies involved in gold mining, and the Huey to gold ratio illustrates the current valuation of gold mining stocks versus the price of gold. Over the last 17 years, the Huey to gold ratio has averaged 0.38, and its December 6th bottom of 0.156 was its lowest level since late 2000, at the very beginning of gold's current secular bull market. NIA realized that gold mining stocks were so extremely undervalued, with a Huey to gold ratio of less than half its long-term average, that gold mining stocks would likely double in 2014, even if gold prices remain flat. Therefore, NIA, on December 28th, suggested for its members to consider the January 2015 GDX $25 call option, which was trading only for $1.92. GDX is an ETF that owns the same exact gold mining stocks that are tracked by the Huey Index. This was NIA's first option suggestion, since it suggested a call option on the silver ETF SLV in early 2010, which gained over 1,000% in 11 months. NIA said that it expected its new GDX call option suggestion to make similar gains in 2014. Less than 3 months later, on March 15th, NIA's new GDX call option suggestion reached a high of $5.19 for a gain already of 170%. To be kept up to date about the U.S. economy, inflation, precious metals, and publicly traded gold, silver, and agriculture stocks, be sure to sign up for the free NIA newsletter today at inflation.us.